exemplo, aqui, né? Aqui fazes um sell, blá 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 blá. Tá a arriscar outro 50, né? Tá a arriscar outro 50 para fazer 100. Podes perder. Dos 250 que fizeste, vais ficar com 200. Ficaste tipo shit. Sei lá, meter um buy. Vai meter um buy. Arriscas 50 para fazer 150, não tem que isso. Perdes de novo. Dos 200 que sobrou, ficaste com 150. Então você terá que perder umas 4, 5 vezes seguidas para voltar para destruir os profits todos de um trade tipo este aqui, 1 to 5. Então, epa, risk to reward para mim, tipo, a melhor cena que você pode fazer. Claro que, epa, a frustração é essa cena de, por exemplo, estás up 1 to 2 almost e a coisa toda reverte. Mas é onde tens que, tipo, fazer coisa. Tens que investir mais no backtesting e forward testing, né? Para teres confiança que, pá, pronto, eu posso meter um trade assim e vai bater, estás a ver? Porque aqui, para mim, a única forma de like, fazer risk management agora, assim, like trade management, seria fazer isto aqui. Stop loss to break even and just hold the trade. Mas I wouldn't close partials because I want to get that risk to reward. Mas entraste agora ou... Mal. 5 minutes. Nice. Tem news, pá. Caraças. 3 minutos. Ei, tá vendo onde nos vai ir, senhor? Ei, papai, eu esqueci que há news. Ah, sério, não dá para controlar. 2. Já, 2 minutos agora.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Senhora está a proteger por causa de news.
Bloomberg Invest is back. Join me, Shonali Bassick, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy,
Pode
how
meter full
AI is
screen.
being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York
Esse
City.
full screen.
Register your interest to attend at bloomberglive.com/invest.
Eu estou a proteger esse meu break-even.
60 minutes away from the opening bell, seconds away from some economic data stateside. Mike McKee's going to break that down in just a moment. His scores are shaping up as follows. On the S&P, positive by 0.6%, up by 0.75% on the Nasdaq 100. In the bond market, let's check the scores. 2-year, 10-year, 30-year. Your yields looking like this across the curve. On a 2-year at the moment, at the front end of the curve, we're higher by a single basis point at about 4%. On a 10-year, up by 2 to 4.28. With that economic data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, the numbers are just beginning to cross, and we do get a big jump in
Já está
the
aberto.
number of jobless claims, up to 242,000. Last week's 219 revised
Eu
up
meti
to
e me tirou
220.
agora.
On a continuing
Yeah,
basis,
that's not case.
1,862,000 from 1,867,000, so not a major change there. Now, the number that everybody wants to see in terms of jobless claims is whether we're having a Doge effect yet. And right now, initial claims for former federal civilian employees were only 614. Now, these are
Porque
2
eu também
weeks delayed. So
estou
this is
com aquela visão
as
de
of
pronto,
February
podemos
15th.
ter
So we
saltos
are
a
not
qualquer
seeing a
momento.
Doge
Então,
impact there in terms of federal workers.
yep,
Could be some
closed it.
contractors laid off, but we don't have the exact numbers. The biggest
Yo,
increases
what the
in
hell?
claims the week before, Kentucky and Tennessee, don't suggest that we're getting a
Bro,
lot
I had
of
the trade set up
Doge
on
impact as well. So we'll have to look more deeply into that. We also get durable goods orders, and these are January numbers, so these are more relevant than stuff we've been getting recently, up 3.1% after a drop of 1.8% in December. Capital goods orders ex-air, non-defense, up 0.8 after a 0.2 revised number in December. So good news on the business spending side. And then finally we get GDP. No change. This is the first revision to first quarter GDP, 2.3%. A little bit of a change in personal consumption, rises to 4.2%. Well, it actually comes in at 4.2, which it was. The expectation was it would be revised down a little bit. So all in all, the big number of the morning appears to be initial jobless claims, but we don't have an exact reason why that has jumped. It does not appear to be federal workers who are claiming benefits. And remember, they have their own separate program from the overall unemployment compensation plan.
So, Mike, we'll give you a few minutes to go over the numbers, and we'll come back to you. That data point competed with better data elsewhere. So think about that as we take you towards the bond market, where yields are still higher by 2 basis points on a 10-year at 4.28. At the front end of the curve, still up by a single basis point, just north of 4%, close to 4.1% at the front end of the curve. Equity futures, little dip, bounces back, still near session highs, up by 0.6% on the S&P. Caught my eye. Lisa, I'm sure it caught yours, 242 on jobless claims.
At a time when, if Mike is reading the data and telling us, and I believe him, that there isn't a huge federal employee input and you have to probably back out some contractors, that means that there just were more people who lost their jobs in this past week, aside from what we're seeing in Doge. And if that's the case, it does suggest more weakness. 1 week does not make a trend. This blip isn't catastrophic, and that is the reason why it is not overwhelming better than expected data in other places.
A week tomorrow. Payrolls.
Yeah.
It's coming up quickly. I can give you a sneak peek of our survey right now. 155 so far is the median in our survey. We'll build that survey out over the next week or so, and we'll bring you some fresh numbers. But 155 is the number at the moment. The previous read, of course, 143.
It's going to be also participation. It's going to be what we see with jobs, how much the wages are going up. There has been a shift of this stagnation in the labor market, and yet it does seem like the leverage has shifted back to the employers at a time where they're saying, get back to the office. We need this from you, we need this from you, we need this from you. And people say, yes, yes, we're going to be there. And that, I think
Jamie Dimon at JP Morgan made that clear, didn't he?
He did. He did.
At a town hall meeting a few weeks back.
He made that very clear. And he's saying, I've been back in the office through the pandemic. Where is everybody? And you're seeing that reflected across the United States.
Joining us now to extend the conversation, Lauren Sadell-Baker of ITR Economics. Lauren, welcome to the program. Let's just recap the economic data. I'm sure you looked over some of it and heard the commentary from Mike McKee. What do you think?
Overall, no change to the outlook. This is kind of business as usual. No change to the GDP numbers. Growth is still slowing, but staying positive. So I do see these jobless numbers as a little bit of a hindrance. Again, as you just said, 1 week does not make a trend. Even 1 month does not make a trend. But we're getting that continued story of a little bit of directional deterioration in the labor market. But coming from such an incredibly tight starting point, we had this room to lose.
Lauren, we've seen the economic data soften, though. The soft data has got softer. The survey data on the consumer, we saw that in UMich last Friday, saw it from the conference board earlier this week. How much attention do you pay for those numbers? And typically when you start to see them weaken like that, do you see it bleed into the hard data eventually?
Consumer sentiment data, I pay almost no attention to. What we see right now, especially from the Michigan data, is that it just diverges so much by Republican or Democrat, how I personally feel about my own inflation rate, right? Do I own my home or do I see my rents going up? So consumer sentiment is a notoriously terrible leading indicator. What I'm more focused on is something like CEO sentiment, and all of those surveys are showing more optimism, showing higher growth expectations for this year, showing more demand to be hiring, especially in the second half of this year. So I think for the more reliable leading indicators, that's where we still do see green shoots. It's just going to be muddling through the political noise in the short term on the consumer front.
Just to give some perspective, the 242,000 of the initial jobless claims that were reported was in tandem last seen on December 6th, and then previously seen much higher than that in October. So these numbers have been jumping around, Lauren, to your point. That said, when it comes to policy changes, we were speaking with Torsten Slock of Apollo, and he was noting that for every federal employee, there are 2 contractors that also lose their jobs. Are you expecting a significant footprint in these reports that really stem from some of the DOGE efforts in D.C.?
Significant is the key word there. I don't see that happening, at least yet. There's so much uncertainty, even with the reported numbers of, DOGE's self-reported savings have come under question. So I think the grand economic story is that there are still skills gaps, right? Especially on the manufacturing and construction front. Maybe some of these other sectors, like federal workers, like tech, that's where we do see a little bit more laxness in the labor market. But generally, this is still a tight market. We still see a lot of opportunity from that kind of core or median U.S. consumer. So we'll watch very closely, but we need some people, at least, at work in the federal government for it to keep on turning.
Lauren, one other thing that Torsten Slock was saying is that all of what we're getting right now, the muddle, is setting up a stagflationary-like environment, and that you could get a slowing in growth at the same time that you get a pop in inflation. And I'm looking at some of the numbers, and I understand that they're backward-looking revisions, but if you take a look at core PCE prices in the fourth quarter GDP, they were revised upwards, 2.7% from the initially reported 2.5%. I just wonder at what point you start to see inflation concerns bleed into some of the data and then, in turn, into markets.
I do see inflation concerns. We'll get the new PCE data tomorrow, and that one's going to be very closely watched because, as I keep saying, 1 month does not make a trend, but does 2 months, does 3 months? We've started to see this relatively sustained inflation, a little bit more to the upside of what the market has expected. So I fully expect inflation to be coming back, especially by the second half of this year, but I think that timing might be bleeding a little bit earlier in some of these key categories that are really pressuring our consumer.
Lauren, appreciate your time. Still constructive on a consumer for the moment. Lauren Sadell-Baker there of ITR Economics. Mike McKee breaking down the data moments ago. GDP, jobless claims, durable goods, capital goods. Mike, you've had a few minutes to go over it all. What jumps out?
Well, you're going to hate me for this, John, but I'm going to dismiss the number for jobless claims this week because we did have a holiday last week, and the seasonal factors expected a drop of 22,000. We only got a drop of 2,000, so artificially increased there. When you look at a state-by-state breakdown, the number of claims that went up were in Massachusetts, basically, and Rhode Island. Big drops in a state like California. So it doesn't look like this is something that's related to what's going on in Washington. And as as we mentioned, only 614 federal workers filed for unemployment last week. The other thing I would note is that in the durable goods numbers, this is a Boeing story, a big increase, 93% in terms of what Boeing orders came in during the month, and that pushed up the overall number. But still, good news on the capital goods numbers that excludes those aircraft, up 0.8, does suggest that businesses haven't pulled back yet, although interestingly, we did see a pullback in orders for finished metal products. In other words, maybe some people were not putting in orders because they're worried about prices going up.
Mike, I'd never hate you, and I think most investors are listening to the same thing based on what the bond market's doing. Mike McKee, thank you, sir. Bonds are where they were going into the data. Yields are higher by 2 or 3 basis points across the curve. And what Mike was saying there is that there are seasonal effects that are artificially increasing some of these numbers. And frankly, that's the point when you take a look at the data. It's like, it's not exactly like a straight line, and it's been some knowledge. I just love the sound effects. Where have they been? Well, it's like brick out from my childhood. Perfect. George Bory of Allspring Global Investments, entertained as well. He's alongside us. George, good morning. It's good to see you.
Yeah, good morning, John.
The whole country's in wait-and-see mode, seemingly. We've heard it from CEOs, seen it from consumers. Anyone in a position to make a decision is in wait-and-see mode. What does that mean for the Federal Reserve?
Well, the Federal Reserve is clearly in wait-and-see mode. I mean, I think they led the charge in sort of guiding the market to sort of wait and see. Their data dependency has basically, obliterated forward guidance for the most part, and they are clearly waiting to see what happens. But as we talk about the data, as we talk about sort of where we are currently economically, the economy is still in a pretty good spot. We're talking about some very granular changes on the margin, which is what we're supposed to do, but they are pretty granular and pretty minor at this point. And so there's this sort of whiff, if you will, of stagflation sort of maybe creeping its way into the narrative as confidence in some areas kind of weaken. Some of the data looks maybe a little bit softer. The more important data is certainly on the inflationary side, where this persistence, this stickiness in inflation it's real, it's here, and it's not going anywhere. And so from the Fed's perspective, though, I mean, if they look at a labor market that's fully employed and inflation that is sort of fairly contained with maybe some upward pressure, they are very happy to just sit and wait. That makes it tough for bond investors, but I think that's where they're going to be for quite some time. That explains what's happening at the front end of the curve. Just go further out along the curve for us. Yeah. 7 weeks now of falling yields. What explains that? Yeah, I think that there's some technicals. The seasonality within the bond market is favorable, and again, the wait-and-see mindset is alive and well in the bond market. Sort of look at our own positioning as we've sort of gravitated a little bit more towards a neutral duration position. I think many of our competitors have done the same, and we're sort of waiting to see, is inflation really going to break out, or is it going to subside or remain contained in some way, shape, or form? And so positioning doesn't look overly stretched. And you've seen kind of the range in, say, 10 years really compressed. We're at the bottom end of the range now, but call it 4.25 to 4.75. We had been hovering right around 4.5. That's a pretty tight range, and we've been there for the last few months. I don't think we're going to break out anytime soon. I think we'll be stuck in this range for a little while. But Lisa, as you mentioned, tomorrow's inflation data, pretty important. And the labor market data will be very important because that's what drives the Fed. You sound very calm and measured. But we've been seeing not just the data going up and down and swinging pretty violently, but the narrative in the market shifting pretty violently, and maybe it's just us, but people talking about growth concerns over the past couple of weeks, not inflation concerns. You're sticking with the inflation concern. You said that you've moved more neutral in duration. You think that the Fed is stuck in neutral, and is this neutral? I mean, are you thinking that basically the inflation is the bigger risk than some sort of real decline in growth? For bond investors, yes. So inflation is certainly the biggest concern that we're focused on. The growth data is still looking reasonably healthy. I think on the margin you could start to suggest that there is some softening, but not enough for we think, to kind of get super alarmed in terms of heading into a recession or a dramatic slowdown in the near term. I think that the market is waiting to see what comes out of the administration in terms of taxes, in terms of deregulation, and then certainly the ongoing discussion as it relates to tariffs and immigration. So these are big factors. They're enough perhaps to kind of pull in the range just a little bit, but we have an economy that is fully employed. People are spending. Now the distribution of that spending is pretty skewed. The high end is still doing very, very well and still spending a tremendous amount of money. And at the lower end of the economy, people are spending everything they have. And still kind of drawing down where they can on debt. So there's not sort of obvious signs to us that the economy is about ready to roll over, but inflation's real and it's persistent. And so as we sort of see it kind of gnaw its way back into the narrative, if you will, and into the data, that is something we think bond investors have to stay very, very focused on.
Which sounds like a great environment for credit. It sounds like a really good environment for companies to be able to borrow and actually pay it down while also managing some of these risks and giving investors a bit of a cushion, a buffer from inflation. But valuations are really hot.
Yes.
So how do you play that?
Sure. Spreads are tight. We know spreads are tight. And what we like to say, there's elements of a super cycle in the world of corporate credit in particular. And that has a lot to do with what happened, really coming out of the great financial crisis, low interest rates, lots of low-cost debt on balance sheets. That creates tremendous financial flexibility for companies, the ones that have it, and that lasts a long period of time. We are in that long period of time. So credit spreads are tight for a reason, and there are many companies that are on the right side of inflation. Inflation, can be destabilizing when it becomes too volatile or it rises too high. But modest inflation is actually a fairly good operating environment for companies and for any indebted entity. As the sort of value of that debt gets sort of inflated away through time, that's good for credit. It's not a great value trade, sort of just 80 basis points for investment grade credit or 300 basis points for high yield. It's just enough to kind of keep you engaged. It's not a lot to get you wildly excited, but it's very appropriate, we think, for this type of environment. So we want that, our central message, the all-spring message to bond investors is yield, yield, yield. Take what the market offers. The market offers a lot of very attractive real yields, whether it's versus treasuries, corporates, asset-backed mortgages. Take that real yield, sort of compound that through time, and just let your portfolio grow. It's working. It's working in real terms. It's not wildly exciting, but it is working, and we want that sort of in our portfolios.
It's certainly calming listening to you, George. It always is. It's good to hear from you. George Bory there of Allspring Global Investments. We're just hearing from the Richmond Fed President, Mr. Barkin. President Barkin talking about a couple of topics. I'll pick up on one, and that's on what's happening with the job situation, saying that we're seeing a lot of uncertainty on the firing side, that the firing of employees on the government side is real. For hiring to rise, businesses need to have confidence. Watching these Fed officials dance around the changes in policy down in Washington, D.C. is quite something.
Well, especially at a time where you then have to translate this into what it means for policy. Some people speculating that some of the uncertainty is going to let the Fed hold rates where they are for longer. That said, you can make an argument with this level of uncertainty that it would encourage them to cut more quickly. So it sort of raises this question, okay, I understand that they're trying to figure out how to interpret this and feed this into their models, but does it make them more prone to keep rates where they are or to cut?
So just getting a comment from the President of the United States, Lisa, as well on trade. So a post on True Social. This one will take a while, so forgive me. I want to go through it and get you some of the information. Drugs are still pouring into our country from Mexico and Canada at a very high and acceptable level. A large percentage of these drugs, much of them in the form of fentanyl, are made in and supplied by China. More than 100,000 people died last year due to the distribution of these dangerous and highly addictive poisons. Millions of people have died over the last 2 decades. The families of the victims are devastated and in many instances virtually destroyed. We cannot allow this scourge to continue to harm the United States, and therefore, until it stops or is seriously limited, the proposed tariffs scheduled to go into effect on March 4th in capital letters will indeed go into effect as scheduled. China will likewise be charged an additional 10% tariff on that date. The April 2nd reciprocal tariff date will remain in full force and effect. Thank you for your attention to this matter. Of course, some confusion yesterday about where we actually were when it came to the schedule of events.
This actually clarifies a lot. What this tells me is he's looking for a deliverable that he can deliver early next week on something with respect to fentanyl and immigration with Mexico. If he can deliver that, then we're going to get the April 2nd back rather than the March 4th. It also points to the fact that this is being used as tariffs to put tariffs on China that will stick, and it raises the tensions there. But to me, this clarifies what the deliverables are and what he's looking to get done.
One step further, additional tariffs on China as well. Equity futures just falling away from session highs there. We're still positive by 0.4%, just not as high as we were. In the bond market, yields were higher by 2 or 3 basis points off the back of the economic data. Yields still basically where they were on the 10-year, up by 2 basis points. We'll head down to Washington, D.C. in just a moment and catch up with Anne-Marie on these comments from the president. Before we get there, let's give an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just to recap the data that was out moments ago, initial jobless claims rose more than expected to 242,000. But as Mike McKee pointed out, the increase was led by Massachusetts and Rhode Island, which both have been hit by wintry weather. Meanwhile, GDP growth last quarter was left unchanged, and core PCE inflation was adjusted higher to 2.7% from 2.5%. Secretary of State Marco Rubio laid out a strategy for managing Russia's relationship with China. He says he wants to dilute ties between the nuclear powers. Rubio also warned that closer ties between the two would be a problem if for the U.S., if Moscow became the, quote, permanent junior partner to Beijing. President Donald Trump says that he plans to revoke Chevron's oil license to operate in Venezuela. Trump cited electoral conditions and the country's failure to take back migrants from the U.S. as quickly as it promised. Under the terms of the license, Chevron would have a 6-month wind-down period to exit operations in the country. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the program, we'll head down to Washington and get you the latest on the trade front from the President of the United States.
Estás a ver DXY? Isso não estava assim, bro. Mas lá, 5 minutes? Porque isso não foi durante a news. Não, quando a news foi lançada não estava assim. Bela time. É tipo aí embaixo. Para 5 minutes? Yeah, quando a news foi lançada, a cena fez tipo uma cena like indecision depois da news é que a cena começou a disparar. NYSE in 10 minutes. Disseste o quê? Qual? Qual delas? Com os pais ou... Calma na câmara para não meter quase. Com pais de sales? Para quanto? E essa consolidação foi feia. Essa consolidação foi ugly. Qual vai fazer breakout? Não. Nossa. Vamos lá, entrando aqui. Aonde? Mostra lá. Estás onde? Não dá a mostrar o screen ou... Hã? Yeah. Drawdown gráfica de... Hum, suka. Suka. Bro, na gold tá se manipulado, juro. Suka. Esse drop aconteceu em 1 minuto. 70 pips. E bro, suka. Isso não é manipulation aqui, é bro. Foi. Facundo. Vamos lá, se mover mesmo, normal. That's a week I'm already done. This week I'm done. Eu já não nada, honestamente. Mas eu estou a ver manipulation. Esses movimentos não são normais, acredito. Gi. Ma quiseres terminar a live dessa, não, oxe, não há nada no charts, não é nada disso, epá. Então, porque essa nessa terminar a live, isso dessa, não, olha, pá, vamos bazar. Não, ok. Mas quando quiseres terminar um meeting, isso dessa, não, né, tipo, epá, não tem certeza de muita coisa também, eu tô aqui, só tô fazendo pausa, não tem que fazer outras cenas, tipo, teclado, não sei o que, não sei o que. Oh, nice, ok.